Have you ever pulled up a financial chart, stocks, crypto, whatever, and just stared at that blocky mix of red and green, feeling like you're trying to read, I don't know, some kind of alien script?
Oh, definitely. It looks complex,
Uh-huh.
maybe even intimidating at first. You sense there's vital info there, but the language itself feels, well, foreign.
Exactly. Today, we're diving deep into the book that really cracked that code for the modern trading world, Steve Nison's Japanese Candlestick Charting Techniques.
Yeah, and our mission here is pretty clear. We want to give you a shortcut to understanding what these patterns are actually showing us about market psychology.
It's not just lines on a screen.
No, not at all. It's about reading the emotional temperature of the market, seeing that constant battle, that tug of war between the buyers and sellers play out visually.
And the really wild part, this whole system wasn't cooked up in some Wall Street lab. It goes way back.
Way back, we're talking 18th century Japan, and it wasn't about tech stocks. It was about rice.
Rice. Okay, set the scene for us.
Right, so imagine the commodity markets in Osaka. Rice was huge, fundamentally important to the whole economy. And there was this trader, Hama, a legend.
And he saw something different.
He did. Well, everyone else was focused purely on, like, supply numbers, harvest reports,
Right.
the usual stuff.
The fundamentals.
Right. Hama noticed something else. He realized through just careful observation over years that the emotions of the traders, their fear, their greed, their hope, were massively influencing the price, often more than the raw data.
So he saw these irrational swings that pure logic couldn't really explain.
Precisely. He figured out that price movement was maybe, 90% psychology. He needed a visual tool to capture that emotional conflict.
And that's where the candlestick comes in.
That's the birth of it. And because it gave such an edge, this knowledge was kept, well, pretty secret in Japan for generations.
Wow, just passed down?
Seems so. Until the 1990s, when Steve Nison did this incredible work, he uncovered it, translated it, and brought it to the West. Honestly, it changed technical analysis forever.
Okay, so let's break it down. Before we get into the really complex patterns, we need the basic building block, the single candlestick. What's packed into that one little shape?
It's incredibly dense with information. For any time period, you choose a day, an hour, even a minute. Each candle gives you 4 key price points.
4 points. Okay, what are they?
You got the open price, where trading started for that period, the close price where it ended,
Right.
then the absolute highest point the price touched, and the lowest point it hit.
Open, close, high, low. Got it. And the main part, that thick rectangle, that's the real body.
That's the real body, yeah. And its size and color tell the main story of that session.
How so?
Well, the color depends on the relationship between the open and close.
Yeah.
If the close is higher than the open, the body's usually green or white. Sometimes buyers won the session, pushed the price up.
Okay.
If the close is lower than the open, it's red or black, bearish. Sellers were stronger. They drove the price down during that period.
Simple enough. But then you have those thin lines sticking out. The shadows or wicks.
Right. And those show you the drama, the volatility within the session. They mark the high and the low price reached, even if the price didn't close there.
So a long shadow means,
Right.
what, a big fight happened.
Exactly. A long upper shadow, for instance, means buyers tried really hard to push prices way up to that high point, but they failed. Sellers pushed back hard and the price closed much lower. That shadow is like a visual record of rejected higher prices.
Oh, okay, so it's about failed attempts too.
Definitely. And a long lower shadow tells the opposite story. Sellers tried to tank the price, pushed it way down to that low, but buyers stormed back in, refused that low price, and drove it back up towards the close. It shows resilience.
So if I see, say, a small green body, but a really long lower shadow, what's the story? The story is sellers made a big push down, maybe tried to break support, but buyers came in strong, completely rejected those lower prices, and managed to close it higher than the open. It's like a counterattack was successful.
Okay, I'm starting to see it. You're reading the narrative of the battle.
That's the key, and a tiny body with long shadows on both ends. That's pure indecision, a real tug of war. Nobody could gain control. The market's uncertain.
Which brings us neatly into patterns. Because individual candles tell part of the story, but Nison showed that specific combinations patterns can signal bigger shifts, right? Potential turning points.
Precisely. This is where the analysis gets really powerful. Think of these patterns as a field guide to spotting when market sentiment might be about to reverse course.
Okay, let's start with the hopeful signs. Bullish reversals. These pop up when a downtrend might be ending.
Yeah, they signal that selling pressure might be exhausted, and buyers are starting to gain the upper hand. And the classic example is the hammer. You sort of described its shape already. Short body, long, lower shadow.
Right, it looks like a hammer. And appearing after a downtrend, it's significant because that long lower shadow shows sellers tried one more time to push prices down hard.
But they failed.
They failed. Buyers stepped in, absorbed all that selling, and hammered the price back up to close near the high. It's like the market is trying to hammer out a bottom. Psychologically, it suggests the sellers might be spent.
Makes sense. What about patterns involving more than one candle, like the bullish engulfing?
That's a strong two-candle signal. You see a small bearish candle first, so a down day. Then the next session opens, and you get this big bullish green candle that completely engulfs the entire real body of the previous red candle.
It just swallows it whole.
Exactly. It visually shows that the buyers came in with such force, they not only erased the previous session's losses, but pushed significantly higher. It's a very clear statement of renewed buying power.
Okay. And then there are three-candle patterns, like the morning star. Sounds hopeful.
It is. It's a beautiful narrative, really. It starts with a large, bearish candle representing the ongoing gloom of the downtrend.
The darkness.
Right. Then comes a small-bodied candle, could be red or green, often gaps down slightly. This is the star. It signals indecision, a pause, maybe the sellers are losing steam.
A glimmer of hope?
A glimmer, exactly. And the crucial third candle is a strong bullish one, closing well into the body of the first bearish candle. It confirms the reversal. Darkness, glimmer, then dawn.
Okay, I like that analogy. Now let's flip it. What are the warning signs? Bearish reversals. Signaling an uptrend might be topping out.
These are the patterns you watch for when things have been going up for a while. The counterpart to the hammer is called the hanging man.
Wait, you said it looks identical to the hammer. Short body, long lower shadow.
Visually, yes, they can look the same.
So how do you tell them apart? Isn't that confusing?
This is Nison's crucial point and maybe the most important rule. Context is everything. Location matters.
Okay.
The hammer appears at the bottom of a downtrend. The hanging man appears at the top of an uptrend.
So same shape, different meaning depending on where you see it.
Precisely. That long lower shadow on the hanging man, seen after a strong rally, tells you that during that session, sellers managed to push the price down significantly, even though buyers brought it back up by the close.
The fact that sellers showed that much strength is a red flag.
It's a warning sign, yeah. It suggests the market is becoming vulnerable, potentially losing its footing. Significant selling pressure emerged, even if it didn't win the session outright.
Got it. Context dictates interpretation. Makes sense. What about the bearish version of the engulfing pattern?
The bearish engulfing. Just as dramatic as its bullish counterpart, but in reverse. You have a small green candle during an uptrend.
Buyer still feeling good?
And then the next session, boom, a massive red candle opens higher perhaps, but then closes way down, completely engulfing the previous green body.
So sellers just overwhelm the buyers.
Completely. It's a sign that control has shifted decisively. The previous session's optimism is just wiped out. It's often a very potent signal.
And the darker twin to the morning star, the evening star.
The evening star signals twilight for the bull run. Same structure, different sentiment. Starts with a strong bullish candle in the uptrend.
Market still climbing?
Then, that small-bodied star, often gapping up slightly. Indecision sets in after the run-up. Maybe buyers are getting tired or cautious.
The pause.
The pause. And then the third candle is a strong bearish one, closing deep into the body of the first bullish candle. It confirms the doubt, signals the momentum has broken, and sellers are taking charge. Euphoria, doubt, then decline.
Okay, this is fascinating, seeing the psychology laid out. But here's the part that I think really matters, and you touched on it in Nison's big warning, right? These patterns aren't foolproof predictors. Absolutely not. And this is critical. Nison was incredibly clear about this. These are signals, clues, indicators of potential shifts. They are not guarantees. You can't just blindly hit buy every time you see a hammer. So context again. What kind of context makes these signals stronger?
This is where you combine the Eastern visual analysis with standard Western technicals. The most powerful confirmations come when these patterns appear at significant technical levels.
Like what? Support or resistance zones?
Exactly. Imagine seeing a perfect bullish engulfing pattern form right at a major long-term support level where the prices bounced multiple times before.
Okay, that feels much more significant than seeing it randomly in the middle of a chart.
Way more significant. The support level tells you where a reversal is historically likely. The candlestick pattern tells you when the psychology is actually shifting at that level. It's the confluence, the combination, that provides the high probability setup.
So Nison encourages using these alongside things like trend lines, moving averages.
Yes. See a hammer form right on the 200-day moving average. That adds weight. See an evening star appear right after hitting a major resistance line. Pay attention.
And volume must play a role too. Does a pattern mean more if lots of shares traded hands?
Huge role. Volume confirms conviction. If you see a potentially powerful reversal pattern like that bearish engulfing, but it happens on really weak, below-average volume,
It might just be noise, not real selling pressure.
it suggests a lack of commitment behind the move. But if that same bearish engulfing happens on a massive spike in volume, that tells you institutions, the big players, are likely involved. The selling is serious. Volume validates the candle's story.
So it's about putting the pieces together. The pattern shows the immediate psychology, the location gives it context, and volume confirms the strength of conviction.
You've got it. It's not magic. It's about reading the evidence more deeply. Nison basically gave traders a richer vocabulary, a more intuitive way to see the emotional struggle behind the price movements, rather than just looking at lines or closing dots.
It really does feel like learning to read the market's emotional pulse. And it's amazing that a technique developed for race trading centuries ago is still so relevant in today's crazy fast markets.
The core human emotions driving markets haven't changed that much. Fear and greed are timeless.
So next time you pull up a chart, don't just see those red and green boxes. Try to read the story. Look for the failed pushes, the moments of indecision, the confirmed shifts in power that the candlesticks are showing you. And maybe consider this, now that you have a way to visualize the intensity of that fight in each candle, think about how fast sentiment can shift in our hyper-connected world today. When you see a pattern like a bearish engulfing form, especially with sudden huge volume, how much quicker could that reversal cascade now compared to Hamas time? What does instantaneous feedback do to market psychology? Something to ponder.